All right, let's just dive right into this. Welcome to this explainer, where we are literally taking apart the engine of commercial banking. If you've ever found yourself wondering how money actually moves, how it grows, and how it essentially powers the entire economy, well, you are definitely in the right place. Today, we're doing a deep dive into the primary functions of commercial banks, and we're going to break down the mechanics of this financial engine step by step.
So right off the bat, what actually is a commercial bank? At its core, it's a financial institution that takes in deposits from the public and then turns around and gives out loans for consumption and investment. But, and this is the absolute most vital takeaway here, despite all the different things they do, their primary motive is always to make a profit. How? Well, they pay a lower interest rate to depositors, we call that the borrowing rate, and they charge a higher interest rate to borrowers, which is the lending rate. That spread between the two, that is their primary source of income.
Okay, so we've got a 3-act breakdown for you today. We're going to start with Act 1, accepting deposits, move into Act 2, advancing loans, and finally hit Act 3, credit creation. Let's kick things off with Act 1, accepting deposits. You can really think of this as the raw fuel of the entire banking engine.
Now, accepting deposits from every class of the public is the absolute fundamental function of any commercial bank. Honestly, without this fuel, the whole system just grinds to a halt. But why do we hand over our hard-earned cash to them in the first place? Well, there are 3 main reasons. First, it keeps our idle money incredibly safe and sound. Second, the money remains highly liquid, meaning you can withdraw at any time just by writing a simple check. And third, you actually start earning interest income the literal moment you deposit your surplus cash. Of course, to attract all these savings, banks have to offer a few different types of accounts. Let's pit the 2 most common day-to-day accounts against each other. On one hand, you've got current deposits, also known as demand deposits. These are mostly used by businessmen who need to run an unlimited number of daily transactions. Because that money is constantly moving in and out, these accounts don't pay any interest, but they are fully withdrawable without any notice. Now, on the other hand, we have savings deposits. These are typically held by households and salaried employees who just have some idle cash sitting around for a short period. These do pay a low rate of interest, but the trade-off is that the bank imposes withdrawal limits. Like, say you're only allowed to write 5 checks per month.
Then you've got your time-based deposits. Fixed deposits are exactly what they sound like. A lump sum of money locked away for a fixed period. We're talking anywhere from 7 days all the way up to 10 years, and you cannot withdraw it early. But because the bank knows that has guaranteed access to that fuel, they give you the highest rate of interest. The longer the tenure, the higher your rate. Compare that to a subtype called recurring or cumulative deposits. With these, instead of dropping a lump sum, you deposit regular monthly installments for a fixed tenure. It's brilliant because it promotes a regular saving habit, and the interest rate offered is nearly equal to a fixed deposit.
Moving right along to Act 2, advancing loans. This is how banks take that fuel and actually power the economy. Because, banks aren't just handing out cash blindly to anyone who asks. They lend to businesses, farmers, and consumers, but only against approved securities, things like gold, silver, government securities, or saleable stock. The first specific type of loan is cash credit. This is a short-term loan, mostly for working capital needs, backed by current assets. But here is the crucial detail you need to remember. While the bank sanctions a total credit limit, interest is strictly charged only on the amount the borrower actually withdraws, not on the entire limit.
Next up, let's contrast short-term outright loans with demand loans. In a short-term loan, a fixed amount is sanctioned for less than a year. The full sum is instantly dropped into the debtor's account, and unlike cash credit, interest is charged on the entire sanctioned amount from day one. Demand loans are a whole different beast. These are highly specific, repayable on demand, with a maturity of just 1 to 14 days, and they're mainly used for interbank transactions. Fun fact, if this money is lent for literally just 1 day, it's called call money. If it exceeds 1 day, it's called notice money.
Now remember those current accounts we talked about in Act 1? Well, they come with a really interesting perk, the overdraft facility. This allows a customer to overdraw beyond their actual balance up to an agreed limit for a short period. Think about it like this. Say you have 2 lakh rupees sitting in your current account, but you draw a check for 3 lakh rupees. That extra 1 lakh rupees, that is your overdraft. The customer pays interest only on the daily overdrawn balance, and amazingly, this is provided without even pledging collateral security.
Okay, this next one is a genuinely clever little mechanic called discounting of bills of exchange. It works in 3 easy steps. Step 1. A creditor is holding a bill of exchange maturing in, say, 90 days, but they need their cash right now. Step 2. They present it to the bank, and the bank drops the cash into their current account instantly, minus a small interest cut, which is the discounting fee. Step 3, when that 90-day period finally ends, the bank just collects the full payment from the original debtor's banker. Simple, right?
And finally, we wrap up our 6 loan types with the one most of us are probably quite familiar with: personal loans. These are offered to individual customers for pretty much any personal purpose, whether you're paying off some old bills, taking a vacation, or just going out and buying a new television set.
All right, here we go. Act 3, credit creation. Or, as I like to call it, the banking multiplier.
This is where things get absolutely fascinating. Credit creation is this almost magical process where accepting deposits and advancing loans allows banks to literally generate new money in the system. The absolute key here is understanding the difference between 2 types of deposits. A primary deposit is exactly what it sounds like, cash a customer physically hands over. But a derivative deposit, that is generated entirely by the banking system. See, whenever a bank grants a loan, they don't usually hand over a stack of physical cash. Instead, they just open a deposit account in the borrower's name. So every single loan creates a secondary derivative deposit. And the creation of this deposit means the creation of credit.
Let's actually trace the flow of this money to see how it works in real life. Say a depositor brings in $1,000. That's our primary deposit. Now, the bank doesn't just keep all of it in a vault. They hold on to a legally mandated portion, which is called the reserve requirement. In this example, let's say it's 20%, which is $200. That leaves $800 completely free to be loaned out to a borrower. But that borrower is going to spend that $800, and whoever receives it, they're going to deposit it right back into the banking system, and boom, the cycle starts all over again.
And you can brilliantly see how these rounds actually play out. Just follow the math here. Round 1 starts with that $1,000 initial deposit, and the bank loans out $800. In round 2, that $800 comes back as a brand new deposit. The bank keeps its 20%, which is $160 this time, and loans out the remaining $640. In round 3, that $640 comes back, the bank keeps $128 and loans out $512. If you follow this process of multiple credit creation all the way down across several rounds until there's literally no more money left to lend, those derivative deposits accumulate massively. That initial $1,000 primary deposit has magically turned into $5,000 in total deposits across the economy.
Which brings us to a beautifully simple formula. It turns all that textbook math into a real aha moment. The money multiplier simply equals 1 divided by the reserve requirement. So 1 divided by 0.20 equals 5. That's a 5x multiplier. For every 1 rupee initially deposited, 5 rupees is created in the wider economy. This multiplier effect, that is the ultimate true power of the commercial banking engine. But this leaves us with a pretty massive macroeconomic question to ponder. If commercial banks are out there essentially creating money with every single loan they advance through these derivative deposits, what actually happens to the entire money supply and the broader economy if banks suddenly get spooked and the lending just stops? It's a lot to think about. Keep exploring these incredible systems, and we'll see you next time.